Apple just dodged a major bullet. The kind of bullet that could have blown a hole through its margins, derailed the iPhone 17 launch, and caused a chain reaction across the global tech supply chain. But thanks to a last-minute concession from the White House, the worst-case scenario for now has been avoided. Today, we are breaking down what just happened with Apple and the US-China tariff war, and how close the company came to a full-blown crisis, and what it means for investors going forward. What just happened? Let's rewind a bit. Just a few days ago, Donald Trump's administration rolled out massive tariffs, up to 125% on goods manufactured in China. These were not just political posturing. They directly threatened Apple's core product lineup: iPhones, iPads, Macs, Apple Watches, even AirTags. But late Friday night, the White House made a critical move. It exempted Apple from these tariffs. That includes not just the China-based 125% duties, but also an additional 10% tariff on electronics from other countries. Now, to be clear, there's still a 20% baseline tariff on China that remains in place. And the administration might still introduce sector-specific tariffs, especially on semiconductor-heavy goods. But for now, Apple is breathing a sigh of relief. According to Evercore ICI, this exemption helped Apple avoid what could have been material cost inflation, and probably save iPhone prices from skyrocketing. Analysts now expect Apple stock to rally after a rough 11% decline this month. Supply chain scramble. Apple's backup plan. Before this exemption, Apple was preparing for war. Their plan: ship US-bound iPhone production to India, where tariffs would be dramatically lower. Right now, India's facilities can push out over 30 million iPhones per year, given that the US accounts for roughly a third of Apple's 220 up to 230 million annual iPhone sales. India could have covered a meaningful chunk. But here's the issue. The iPhone 17 is already well into production, and it's still being made primarily in China. Apple was weeks away from facing the Herculean task of rerouting production, renegotiating with suppliers, and convincing consumers to pay higher prices, all while rolling out a brand new product. And don't forget, Apple's legendary marketing machine would have had to spin the whole situation into something palatable. Financial impacts. Financially, this could have been brutal. If Apple hadn't gotten that exemption, some analysts estimate that iPhones could jump in price by up to 43%. That means a top-end iPhone normally priced at $1,000 and $599 could have climbed to over $2,200 just from tariffs alone. So this decision didn't just save Apple's margins, it saved its pricing power, consumer sentiment, and shareholder confidence. Still, the 20% tariff that remains could trickle into the cost structure over time. Apple might absorb some of that temporarily, but it's not off the hook. And let's be honest, Apple has no problem passing on costs when it has to. Geopolitics and China risk. Here's where things get more complicated. China. Apple generates 17% of its revenue from China. It has dozens of retail stores and is viewed as a premium brand by Chinese consumers. So, what happens if Apple moves too much production out of China too fast? Retaliation. China has already started banning iPhones for government employees and launching investigations into US firms. They can hit back in regulation, custom delays, or consumer sentiment. And here's the kicker: 80-70% of iPhones, 80% of iPads, and 60% of Macs are still made in China. That's over 75% of Apple's total annual revenue, still tied to China-based manufacturing. So even if Apple wants to decouple, they can't just flip a switch. Supply chain strategy. Can Vietnam, India, and Malaysia compete? Yes, Apple is moving. They have ramped up production in Vietnam. AirPods, Apple Watches, even some Macs. They are growing Mac capacity in Malaysia and Thailand. And India, Apple plans to produce 25% of all iPhones by 2027. But here's the reality: no country comes close to matching China's scale, speed, and skilled labor force, at least not yet. So for the foreseeable future, China will remain Apple's manufacturing core, even if diversification continues at the edge. Competitive dynamics. One thing that made this tariff decision urgent: Samsung. Samsung manufactures phones outside China. If Apple had been hit by tariffs and Samsung had not, we would be talking about massive competitive imbalance. Apple would have had to either raise prices or eat margins, both bad options. So this exemption was not just about cost, it was about preserving Apple's global market position. Final takeaways for investors. Here's what investors need to keep in mind. Apple just narrowly avoided a profit margin catastrophe, but the core has not gone away. Trade policy is volatile, tariff can return, and China isn't happy. What we are seeing is a real-time stress test of Apple's supply chain flexibility, pricing strategy, and geopolitical risk management. Long-term, Apple will likely keep pushing production diversification. India and Vietnam will grow, but China remains irreplaceable for now. If you are an investor, watch 3 key things: production diversification speed, China's regulatory tone toward US tech, and how Apple handles pricing if tariffs come back. Because in this environment, flexibility is a competitive edge, and Apple's playing the long game. If you found this breakdown useful, hit like, subscribe, and let me know in the comments. Do you think Apple can truly de-risk itself from China, or are we looking at an unavoidable long-term dependency? I'll see you in the next one.